A very warm welcome and thank you to everyone joining in today. I'm extremely excited for the information that you're going to hear. And in my opinion, this is one of the most important talks that you can hear when planning your future. On the outside, it sounds like it could have the potential to be an extremely boring talk, right? We're talking about retirement planning, the power of tax diversification. However, if you're someone that wants to absolutely flourish in your future years and to run the race that's set before you with strength and with vigor, and to be able to navigate around some of the pitfalls that tie people up because they haven't considered or planned for certain things throughout their retirement, then you're entirely in the right place. I'd love for you to dial in here and to be able to capture and grasp some of the information I'm going to share with you. Hopefully, a lot of new things. And if you're expecting for this to be a typical financial advisor seminar where they basically say, hey, you're earning X, and by working with us, you can earn X plus one, you're in the wrong place. That's not this at all. And in fact, I'm going to be taking a more macro perspective, meaning that we're going to look at the bigger scheme of things and look at the power of balance and diversification and not focusing on one singular thing. So I hope it's very educational for you. And I look forward to dialoguing with you in the future. If some of these things hit home and you want to learn some more, please, by all means, schedule a strategy session. So we're going to dive right in here to things. And thanks again for joining us here. So to kick things off, I always like to lay the landscape to make sure that this is relevant for you. That way you know that, hey, if this is, then you can stay tuned in. If not, you can go on to something more important for you. And so we're going to talk about the problems that we're going to be discussing here. Many Americans, they've done everything quote unquote right according to traditional wisdom as they approach retirement. They've contributed to their 401k or their IRA. They've worked hard at paying off their house. They've saved in hopes of finally enjoying the fruits of their labor during retirement. But there's often a few key things that they've overlooked, including a hidden business partner in their 401k named Uncle Sam. And he also, unfortunately, holds the voting shares and has a lot of say so when it comes to your retirement. So at Life More Abundantly, we help individuals and families navigate through this thing called retirement, around the pitfalls, and help reduce and eliminate Uncle Sam and his say so that they can focus on pouring into future generations and finishing life's race that's set before them. So, quick word on a disclaimer here to keep me in line with compliance. The seminar is for informational purposes only. Neither Life More Abundantly LLC nor its agents or employees are in the business of giving tax, legal, or accounting advice. Attendees should consult their own personal advisors to determine the appropriateness of any course of action. So we'll jump right into the power of compounding interest. Now, let's say I have a job offer for you, okay? So I want to hire you for 30 days and I'm a diplomatic boss. So I'm going to allow you to choose the way that you get paid. So I'll put you on a 30-day contract and I'm going to pay you one of two ways. Option number one is that I'm going to pay you $1,000 a day for 30 days. Doesn't sound too bad, huh? Option number two, I'm going to pay you 1 penny the very first day and I'll compound that penny, meaning that I'm going to double that penny each subsequent day for the same 30-day period of time. So you'll get 1 penny the first day, 2 pennies the second day, 4 pennies the third day, and so on. My question to you is, which payment option would you like? All right, so if you're watching this here at home or maybe on your phone, by a show of hands, who wants $1,000 a day? Okay, so perhaps some of you there. And then I'm going to ask, who wants a penny the first day and a compound that penny each subsequent day? All right, and for those of you that aren't even raising your hands to either one of those, you're hired. You can start tomorrow for free. So let's go through the math here and see how this works out. So $1,000 a day, that sounds pretty good, right? We have $30,000. That seems like a good month's work, right? But by taking that penny the first day and doubling it each subsequent day for the same 30-day period, at the end of the 30 days, it's a little over $5 million. Now, people might go, no way, how could that be, right? But it's simple math. You have the power of compounding interest. And so as you can see here on our chart, you have day one, you have a penny, and then 2 days, you You have 2 pennies, 4 pennies, 8 pennies. Generally at that point, when people start seeing how slow it is to take off, people throw up their hands and they go, okay, I've seen enough, I'll take the $1,000 a day. But if you continue to look at the chart, you look at the power of this illustration when it comes down to time. So when it comes down to time, you get over that 30-day period of time, you have over $5.3 million. So my question is this: where is the power in this illustration? Is it in the value of the penny? No, right? We started off with the smallest amount that we could come up with in American dollars. It's all about the time. See, if I cut that growth time from 30 days to 20 days, or 20 days to 10 days, or 10 days to 5 days, that penny is not nearly as attractive, is it? And so the same thing is true in your life. The longer you wait to plan, who does it hurt? It hurts you, right? And so what this is doing here is I want to give you guys an idea about what the power of time, the power of compounding interest does in your favor. So my question then is, when should you start planning? Should you start planning today? Should you start 10 years from now? Should you start 20 years from now? See, now the power is in starting today. And so I absolutely love using this slide because it really illustrates the power of compounding interest over a period of time. Obviously, a penny is not a lot of money, but it's all about the time. So smaller sums of money compounded for a long period of time can actually still amount to quite a bit. So I want to go through with you the rule of 72. Stated simply, the rule of 72, you can take any interest rate that someone's telling you that you're earning on your money, you divide it by 72, and that tells you how long it's going to take for your money to double. For example, if I say, hey, you're averaging 7% on your money, we divide 7 into 72 and we get 10.2. So every 10 years, roughly, your money is going to double. So when you look at that, if I have 100,000 invested and I have an average return of 7% every 10 years, my money's going to double. So it gives people an idea. Okay, if I'm investing my money, I'm getting a particular rate of return. What will I have in the future? So it's kind of a nice piece, right? It's a pretty cool rule here. You can look pretty smart with your friends, right, or with your clients. You can say, hey, look, you got $500,000 in your portfolio. You're 55. What do you think you'll have in 10 years? And that allows me to look at their historical returns, come up with a fair number as to what they'll actually have down the road, and makes me seem like I'm a genius, right? I'll be like, oh yeah, you've got 500,000 a day, you're averaging 8%, money's doubling every 9 years. I guess you'll have about 1.2 million in 10 years. And they'll go, wow, you're such a genius, Bradley. But really, it's just math, right? This is just the rule of 72. So this is why I bring it up. Ideally, of course, we'd love to get 7, 8, 9, 10%, even 15% returns on our money, so we can get a bunch of doubles in there. And in fact, you have to get some of those types of returns to have a tremendous compounding effect. So let's say that people are earning 1% on their money. Okay, so if we're looking at the rule of 72, 1% into 72 is what? 1% into 72 is 72. So if you're currently relying on CDs, which you'll hear me affectionately call them certificates of depreciation, or you're just relying on your savings account at the bank where you're earning 1%, and in turn that 1% is taxable, so you're actually only earning 50 basis points as your net yield, then this means that your money's going to double every 144 years. So if you're listening to me here, by a show of hands, who has a 144-year time horizon for their retirement? So not seeing too many hands raised here, right? So again, this speaks to the power of compounding interest, but more importantly, the power of getting a good return. So as you can see, even a 1% or 2% or 3% variance in return actually has tremendous effect in how quickly that money will double. This is the risk reward chart. At the top of this chart, I have risk, and you can see high risk at the top. So if I told you I have an investment that yields a 20% return, You'd say to me, great, where do I sign up? That's awesome. But if I were to tell you that in that same investment, you might lose 20% on your money, you might go, okay, wait, hold on, don't be so hasty, right? So below that, I have low risk. If I were to tell you, hey, your money's safe, it's guaranteed, you'll never lose a dime, that sounds pretty attractive. But here again, give you an example like a CD or a fixed account. You only are making 1%, maybe 2%. So again, you can't put all your money there, right? There's the cost of living. We have this pesky thing called inflation. The cost of goods and services going up. Right now, the current inflation rate is about 3%. So if you're earning less than 3% on your money, you're actually losing purchasing power. So we can't put all our eggs in that low basket either, right? To the left, we have taxable investments. Taxable investments can be great because they provide liquidity. I can invest my money, I can make my return, I can get in, I can get out, and that's great, right? But the problem with taxable investments is that they're taxable. Let's assume I earn an 8% return in something. Well, I've got to pay my taxes, right? Uncle Sam takes his cut, he gets his share, so I only end up with 5 to 6%, right? So the downside with these is that I don't get to enjoy the true yield because I have to pay taxes. Now on the flip side, over on the right, we have tax-deferred investments. Tax-deferred investments, they're great because they allow that money to compound uninterrupted, completely tax-deferred. So I make 8%, I get to compound 8%. The problem though with tax-deferred investments is they're generally retirement accounts. So with the exception of one product, which is actually permanent life insurance, all tax-deferred vehicles are retirement accounts, which means that any distributions taken before the age of 59 and a half are subject to a 10% IRS penalty in income tax. So if you're following me through this logic here, it kind of sounds like I'm saying some good things about each of these points, and I'm saying some bad things about each aspect of this matrix. And I am, right? The point here is that there are pros and there's cons to everything. I won't put all your money in high risk investments, nor low risk, or taxable or tax deferred. As you see that circle right there in the center, in the middle where it says balanced portfolio, it's all about balance. I can make any investment vehicle sound good, and I can poke holes through the same offering. And this goes to what I believe. You may hear me say I don't believe in perfect products. So I don't believe a perfect product exists, right? But I do believe in perfect planning. So there's this general premise about money, and here's what I believe. I believe that in general, the best products for short-term liquidity and access to cash are typically the worst plans for long-term growth and income. On the flip side, typically the best plans for long-term growth and income are typically the worst plans for short-term liquidity and access to cash. So if you can grasp this is huge, right? You can see that the money that you have on hand for emergencies and for some opportunities probably isn't going to do a whole lot for you in helping bolster your retirement savings. And on the other side, the money that we're putting away for retirement, it probably isn't the best for emergencies and opportunities. So if we understand that, we see that it's all about balance, right? It's all about diversification. So that way we can feel comfortable funding our short-term, our mid-term, and our long-term goals, knowing that different vehicles offer tremendous strengths for particular time horizons and objectives, but those same products may leave much to be desired in other areas. So our idea here with perfect planning is that we're going to offset the weaknesses of some vehicles with the strengths from others, depending on what your needs are. So this is the defined contribution versus defined benefit column here. To the left, you have defined contribution. So let's say you have an investment like your 401k or real estate or stocks, mutual funds, bonds, maybe you have a business. They're all viable vehicles for accumulating wealth. My question to you is, out of all those offerings that are here on the left, how much income in retirement are they going to yield to you? Right? So what is the exact amount? And the answer is, well, you can see right there the question mark. Rather, we don't know. So now we can assume, right? We can say 4%, 6%, maybe 10%, 12%. We can look at the history, we can anticipate, but the bottom line is we really don't know. It's a question mark. So the only thing we can control on that side is what? Our contribution, right? Not, we don't know the exact benefit, what's going to come out, but we can determine what we're going to put in. And so we don't control what the value is of these accounts, and in turn, and more importantly, what we're going to be able to draw comfortably in terms of income. So to the right of that, we have the defined benefits plan. And this is where we're defining a specific benefit. Now, on the top here, we have pension plans. Pension plans are typically good. You know, perhaps our parents' generation, they worked for companies for 30 to 40 years, and they offered a pension plan. I mean, if you look at the statistics, it's really rather staggering. More and more companies are shifting the onus of planning and preparing for retirement off of their own shoulders and onto that of the employee. So I think today it's less than 20% of companies that offer pension plans, whereas in generations past it was literally reversed. By over 80% of companies offered pension plans. So pension plans are not typically offered in the workplace today as in years past. So we're going to go on to Social Security here. Social Security, it's pretty viable, right? It's a defined benefit. So you work for a particular number of years, you retire at a particular age, maybe 62 or 66, 67, and there's this particular income that you're supposed to be able to draw. So, you know, the question would be, is Social Security viable as a long-term player, especially for younger clients? And if I were to answer truthfully, I'd have to tell you I don't know, right? I don't know this. I know that at its inception, it was created to be a retirement supplement. It was not created to be a retirement plan. And I also know this, that at its inception, there were over 44 people funding Social Security for every one person drawing from it, and that it's currently estimated that in the next 10 years, there's going to be 2 people funding Social Security for every one person drawing from it. So that's a lot of strain, that's a lot of pressure on the system. And again, I don't want to get into the politics or the nuances of the plans that the government set up, but that's certainly burdensome to me. So I don't know how much security I want to put in there, right? So now we have another offering like fixed annuities. The problem here, though, with most fixed accounts right now is that we're in this low interest rate environment. So long gone are the days where you can put your money into a savings account or a banking instrument and get 5 to 6% on your money and just call it a day. So as we talked earlier, those yields are typically 1% or less these days. Which brings me to permanent life insurance. So life insurance in particular, it allows us to pay a particular premium over a certain number of years and have a guaranteed stream of income coming out on the back. So that's why it's called a defined benefit. It allows me to define what I'll receive. I can put in a certain number today, and a multiplier of that number I get on the back end in the future. So that's pretty nice. So now the good thing here is there's a particular question that I want to ask my clients as I'm going through this. Here's my question. As I establish this plan for you, as we're looking at your retirement, and we look at the defined contribution versus the defined benefits, and again, let's keep in mind there's no perfect product, there's no wrong answer, but what percentage of your income in retirement do you want that is not subject to stock market risk, real estate risk, or business risk? In other words, how much do we want to put into the defined contribution bucket versus how much do we want in the defined benefit bucket? And again, there's no wrong answer, right? So some clients, they might say, heck, I want 100% defined as benefit. Some people might say 50%, but even the most aggressive of aggressive investors, they're going to assign some percentage to a defined benefit plan. So if they don't work for a company that offers a pension plan and they don't think that Social Security in the system there is going to be yielding a whole lot, and they don't want something that's yielding more than 1 or 2%, then again, there's one clear-cut answer that stands above the rest, and that's permanent life insurance. So if you follow me here, and why I asked that simple question, what percentage of your income do you not want subject to stock market risk, real estate risk, or business risk? It's because those are the three main asset classes that people generally have that they can object to putting any money into a defined benefit bucket. They could say, oh, well, my equity portfolio is going to do this, my real estate will yield this, or I think I'm going to sell my business for this. And that's not to say that any of those things won't happen, right? But let's provide a stop loss. I'm literally going to draw a line in the sand and I'm going to say, look, I want you to be here or better, not here or worse. So if I can define a benefit of 5,000, 10,000, 20,000 a month, whatever the person needs as that drop dead number, then when your real estate or your 401k or your business does better, awesome, right? I literally hope that the permanent life insurance policy that you buy ends up being the worst performing asset class in your entire portfolio, because if the worst performing asset class in your portfolio gives you a 5%, 6% tax-free yield, you're doing pretty well, right? And there's something that you'll be hearing me reference in the future. It's called the tax equivalent yield. So in order to net 5%, you're going to have to earn significantly more depending on your tax bracket and the state that you live in, all while taking on higher levels of risk. Meaning that if my real estate or my business interest or my equity portfolio yields over 10% consistently for me throughout my working years as I prepare for retirement, that's great. And, then we're matching that 5%, right? So I don't think that permanent insurance is superior to anything else. I wouldn't tell someone to put all their money in life insurance just the same way that I wouldn't say to you, put all your money in a 401k or all your money in real estate or all your money into a business endeavor or any other place. Again, it all comes back to that previous slide of balance and diversification. A helpful way of thinking about retirement funding vehicles is to consider some of the key factors that affect them. And this chart is going to help process some of those things. There's a few questions to keep in mind as we're going through it. Number one, do you put pre-tax or post-tax money into these vehicles? Number two, how is growth subject to taxation? Number three, are the distributions subject to taxation? Number four, is there a unique benefit such as a death benefit? Number five, are there restrictions or requirements tied to the distributions? So what strings are attached when it comes to Uncle Sam's role in your retirement account? So let's take a look here at the graph. When you look at the retirement funding pools and the opportunities that are out there, you've got the 401k. We'll see that here on the left. And with the 401k, there's pre-tax contributions. You have very favorable tax-deferred growth, but then the distributions are going to be fully taxable, meaning that it's coming due here, and there is no death benefit in excess of the value on the account, and there are some distribution restrictions. So for one, you have income limitations. So when you're funding it, you can only make a certain amount of income, and you can only put in so much money. You have contribution limits. Let's see, if you take distributions before the age of 59 and a half, you're going to be subject to an IRS 10% penalty plus your tax bracket. And let's say you've done so well that you don't even need the money. Well, you're going to have to interrupt the compounding and take out distributions. Otherwise, you're penalized if you don't take out the income after age 70 and a half. And that's called RMDs, or required minimum distributions. So a lot of people, they're going to say, hey, I like my Roth. We'll see that one here in the middle. And again, they have some of the same issues. You have contribution limits. You can only put $5,500 into a Roth IRA if you're under the age of 50. And then after that, there's a catch-up clause allowing you to put in $6,500. Now think about it. If I have a client and we want to create for them a nice 6-figure retirement stream of income in the future to last all the way through the retirement, what is putting $5,500 a year away going to do? That's kind of like shooting a BB gun at a tank, right? The effect is almost negligible. So people typically that they're looking to save more and really bolster up that retirement savings, they're going to need an offering that allows them to do more so than in a Roth. So we have these income limitations as well for contributing to it. If you make over $120,000 a year, filing single, you're phased out. Over $180,000 a year, file joint, you're phased out. On the pro side, though, the growth is tax deferred. Your distributions are not taxed on the back end, so that's huge. And again, there's no leverage effect, though. There's no death benefit that's tied in excess of the value, and you're going to be subject to some of the same penalties if you try to take money out early. So if you do qualify for contributions and you take a distribution out before the age of 59 and a half, you're going to be subject to 10% penalty from the IRS on the gains, and you'll have to pay income tax on those gains. And so this is where, again, we can look at using permanent life insurance as a caveat. We have the ability, it works very similar to a Roth IRA, where we're making contributions with after-tax dollars, but unlike the Roth IRA, I don't have any contribution limits or any strings attached from the government. I don't have an income limitation, and so that's why we call this the rich man's Roth IRA. So let's say I want to create a retirement stream of income of $300,000 a year. What I can do is I can use a permanent life insurance contract to get me over the hump or get me closer to that number and not worry about a $5,500 a year cap. And on top of that, we're going to have a leverage effect. So let's say we have $200,000 in cash value in a retirement account, like say a 401k. There's $200,000 in it. Well, when we die, what does the family get? Now, some might say they get the $200,000. Well, no, not exactly. They don't even get the $200,000 because they're going to have to pay applicable taxes. So now on the other hand, though, if we have $200,000 in cash value in an insurance contract, not only would your family get the actual $200,000, if you think about it, there's actually a leverage effect. This thing blossoms. So there's a death benefit there. And what I mean by that is if you have $200,000 in cash value, but it's $1 million policy, not only do you have access to the $200,000, but your family is going to get a five times leverage effect, meaning $1 million of tax-free money that's coming to them via the death benefit. And along the ride, if an emergency or an opportunity comes up before the age of 59 and a half, you have the ability to access those dollars free of the 10% IRS penalty and income tax. So there's some great advantages there. So I don't know if you're aware of this, but today I actually created the perfect retirement vehicle. I'm really excited to share this with you guys. So I want to share with you the perfect vehicle. It has 3 key features, and you'll see them here on the screen. It has contributions that are tax deductible. It has growth that is tax deferred, and so it's just growing and you pay no taxes. And then on the end, when you pay no taxes on the distributions and it comes out completely income tax free. It's the perfect vehicle. So obviously I'm being a bit sarcastic here, right? I mean, if we had a product like this, there would be a line around the corner of clients that would be signing up for this thing, but unfortunately no such plan exists. So these are the 3 things that would be ideal, but we can't do that, unfortunately. However, you can pick 2 out of the 3. So here's the question, my client. My question is, what would you rather do? Would you rather deduct your contributions today and grow a chunk of money that's never been taxed, and then on the back end, we pay income taxes on a larger sum of income in the future? Or, here's another option, we can pay taxes today, we can grow a chunk of money, and then we can pull the distributions on the backside out tax-free. So to put this example in practical terms, would you rather deduct $1 of income today and pay taxes on $4 of income in the future when you take distributions? Or would you rather pay taxes on the dollar today and draw $4 out tax-free? What would you rather do? And so that's really a personal question. There is no right answer, but depending on how you feel, great. Let's explore some planning options. Now, this is interesting because I frequently see a misnomer out there. And this is a common misnomer by clients where that they believe, and they'll think, no, no, you see, you don't understand. See, in the future, I'm going to be in a lower tax bracket. So it's okay that I'm taking my deductions today because when I retire and I'm drawing income, I'm going to actually be in a lower tax bracket. And that's not necessarily always true. If you look here, we're going to go through this logic, okay? So if you look here, this graph shows the historical tax rates from the 1920s all the way to present day. And the interesting thing about this slide is if you look in the better part of the 20s, 30s, 40s, 50s, 60s, 70s, 80s, the highest tax bracket was almost 90%, right? So whereas if you look at where the taxes are today, it's much lower. So even though it doesn't feel like it right now, we're actually in a historically low tax environment, which means for us that if we were to bite the bullet and go ahead and take care of taxes, we're kind of getting things on discount, right? Especially if taxes go up in the future, back to where they've been at historically. So let's think from a macro perspective here. What has our country shown the propensity to do? Well, our country has shown that anytime they've been faced with economic turmoil, they're going to increase tax rates. As evidence of what happened coming out, if you look back at the 20s on the graph here, we were coming out of the Great Depression. The country was in a bunch of need, so they raised tax rates to get more revenue. Well, if you think about it, where we are present day, we've been coming out of two successive dips, right? We had the dot-com crash, then we had the economic crisis in 2008, and we're even in the middle of experiencing another correction right now. So again, what's the trend? Typically, tax rates are going to go up. What's even more so concerning to me though is in the past when tax rates were much higher, the government wasn't sitting on over $17 trillion in national debt. And so that is a bit alarming to me as well. So here's a common question that I ask clients. In the future, do you think that the nation's tax rates are going to be higher or lower? Do you think they'll go up or that tax rates will go down? And so if you think tax rates are going to go up, I would tend to agree with you, right? I think so too. So now let's think through the logic of what we're doing with traditional retirement planning. So if we look at what we're doing and what we're conditioned to do, we're conditioned to make contributions to a qualified plan today in an environment where tax rates are lower. And in doing so, we're putting money in our 401k, we're growing a big chunk of money that's never been taxed, only to draw out larger sums of income in the future when tax rates are even higher. So would it not make sense, at least with a portion of our portfolio, to pay taxes on the seed? So we kind of bite the bullet, we take on the pain of paying the taxes today, but then later on we draw the harvest income tax free. So to me that makes a ton of sense, right? But again, you're going to have a select few people that are going to say, hey, no, Bradley, you don't understand. I'll be in a lower tax bracket in the future. So let's examine this logic, right? Let's assume today that you make $150,000 a year. Let's say we have Mr. Jones and he's making $150,000 a year as income and he's a salesperson. So he's got a few things going on for him, right? Let's say that Mr. Jones owns a home and he has a mortgage payment on that home that's $2,500 a month. So at $2,500 a month or $30,000 a year, if you guys have ever looked at an amortization table on a mortgage, what you'll find is that when you first purchase a house and you're paying down that mortgage, the majority of that payment that you're making is going to interest. So if you look at the mortgage interest on your primary residence, it's actually at that level, it's going to be 100% tax deductible. So if a person is making $2,500 a month or $30,000 a year contributions to their mortgage, it's conceivable to think that $22,000 to $23,000 of that is in interest, and thus it's tax deductible. So for this illustration's sake, let's just round it up and let's say that $25,000 of that interest was tax deductible. So right away, we've taken Mr. Jones' income from $150,000 to $125,000 because we can deduct that interest. Now let's say that he's working a job and he's funding a 401k. So he's putting $17,000 a year into this 401k, and again, he's further reducing his tax liability because he can deduct this. So we've gone down already from $150,000 out of with the interest deduction, we've got him down to 125, and now we have the 401k contribution that's got him down to 107. Okay. So let's say Mr. Jones is married, he's got a couple kids, he has a head of household deduction. So he has 3 kids. He's taking those deductions now too. So we've brought that income down to get yet another $20,000 off. So now we're down to $83,000 in taxable income. And again, he's in sales. So Mr. Jones is traveling, he's taking clients out to dinner, he's putting gas in his car, he's writing off his cell phone and these things. And let's say we get another $20,000 of deductions there. So if you're following me through this illustration and this logic, the net taxable income at that point in Mr. Jones' life is actually $63,000, even though his gross income is $150,000, his net income is $63,000, and that's what he's paying his taxes on. So we fast forward 25, 30 years where this person says, and where this person's coming up on retirement, and we say, hey, look, my income in retirement is going to be $100,000 a year. So he's going to dial it back, right, from $150,000 to $100,000 a year for retirement. And that's what he's making his plans for, right? To have $100,000 a year. And that's what he's got going with the retirement, with the real estate, and everything that he's got going on. That's what it's going to yield him, $100,000 a year. So let's fast forward and let's think this through. At this point, if he's followed conventional wisdom, his mortgage is paid off. Let's assume because he wanted the American dream, he went ahead and paid off his house, and he was told to fund his 401k and just eliminate that mortgage payment. So his mortgage is paid off. He has no interest deduction anymore. The kids are out of the home, so that $20,000 head of household deduction's out the window. He's not working anymore, so he's not funding a 401k, so he's not getting that deduction there. And again, he's retired, so he's not taking these trips and writing off those same things. So in retirement, it's conceivable that the gross income and net income are probably short of property taxes is roughly the same. So let's say you have $5,000 in property taxes, so you're taking that deduction. So now your taxable income went from $100,000 down to $95,000. So if you follow me here, your net income in retirement is $95,000, and your net income while you were working was $63,000. So you'll actually be in a higher tax bracket, paying more taxes while you're earning less gross income in retirement. So people sometimes fail to go through that exercise and to realize where they'll actually be. But does that make some sense to y'all? So I always say it's not a matter of how much you make, it really comes down to what you keep. And that's part of the benefit of looking at this macro perspective. This next slide is going to be super powerful in showing you the impact of diversifying streams of income in your retirement versus relying on qualified plans alone. So let's look at the left. Let's look at this case study of Jim. Jim's retiring. He wants an income of $100,000 a year. And on the left, he has no tax diversification. So he's accessing $100,000 a year from his 401k. And now let's assume that I was wrong. Anyone else who believed that income tax rates were going to go up was wrong as well, and that the rates stayed exactly the same. So in a marginal tax bracket of 25%, let's assume he's losing $25,000 out of his $100,000 of income to Uncle Sam. So that leaves him with $75,000 of net expendable income. Now on the right here, let's look at the impact of diversifying his streams of income in the future. He wants the same $100,000 of income, but he's only going to draw half. He's going to draw 50% of that from his 401k, and out of the other $50,000 a year of income he's going to draw that from a permanent insurance contract. So only the $50,000 that he's drawing from the 401k is going to be taxable, but because he's drawing less income, he's in a lower tax bracket at 15% as opposed to 25%, which gives him a $7,500 annual tax liability. The $50,000 that he's drawing from the insurance contract is income tax free, so that gives him $92,500 of net spendable income when all is said and done, as opposed to $75,000. That's a little bit over $17,000 annual difference, and played out over the course of a 20-year retirement, that's over $340,000 of additional spendable income in retirement. To which I'd ask anyone listening to me today here, who would like an additional $340,000 to spend in retirement? And I don't think any of you should not be raising your hand, right? So again, it's not a matter of how much someone makes, it's a matter of how much they keep. This glorious picture here is Mount Everest, and I'm sure most of you have heard of Mount Everest. It's the climber's dream to actually get to the peak of Mount Everest, and it's quite the challenge. So what is the mountain climber going to do? They're going to train, they're going to bring the necessary supplies, and boom, they're on their way. So just like us, just like our clients, we're bringing the necessary supplies. Our Mount Everest, though, is retirement. So what are we going to do? We're going to try to eliminate debt. We're going to try to save for retirement. We're trying to get our kids into the best schools and out of the house. And that's the peak, right? That's the end goal, is to get up to the top of Mount Everest. Well, there's one day where that mountain climber is going to finally get to the peak of Mount Everest. And I'm sure each of you, my clients, are going to get to your peak as well. You'll turn 65, hopefully with a couple $1,000,000, and you'll have eliminated that mortgage payment, and you'll have your kids out of the house. You finished, right? You got to that peak. But interestingly enough, did you know that more people die each year going down from Mount Everest than die going up it? And it's the same fate that befalls so many people out there when it comes to their retirement. They get so concerned with paying off that mortgage, they're so concerned with funding that 401k, that they fail to consider the exit. Did they consider the impact of inflation on their portfolio? Did they consider we talked a little bit about the Rule of 72 earlier on. So on that note of inflation, at a 3% inflation rate, the value of money is chopped in half every 24 years. So if I think I need $100,000 a year of income to be comfortable in retirement, and I'm thinking about that in today's dollars, I'm actually going to need to shoot to have $200,000 of income in retirement after 24 years, right? So does that make sense? So because I'm going to lose my purchasing power over time. So look at the stock market. It's crazy, right? Again, we're in the midst of another correction now. In 2008, what happened? There was a huge drop, over 40%. In 2001, we saw the same thing. We saw the dot-coms become the dot-gons. And so imagine you retire. Imagine you did it. My advisor told me that if I had $2 million and it was earning 5% on average, that I'd get $100,000 a year of interest and income in perpetuity if I did it. So I got to retirement. I got my $2 million bucks. I'm going to take my 5% distribution. So let's imagine that that's the position that you're in, and boom, we have this huge correction and the market drops 40% again. So you see your 2 million drop to 1.2 million just in 1 year as you're coming into retirement. And lest we forget, you still needed your $100,000 of income, didn't you? So you drew that. So in 1 year, you watched your portfolio drop from 2 million to 1.1 million. What do you do? I mean, are you going to stay in the market because we're in this for the long term? Or did you go, oh my goodness, I'm out of here, move me to cash, in which case you won't lose money anymore, but you also won't make it anymore and benefit from when it rises back up. So, you're going to lose money fairly quickly. If you keep spending at that same rate, you're going to be out of money within 10 to 11 years. So what are you going to do? Do you look at different offerings that are going to limit your market exposure and guarantee income? I mean, I don't know. It's just a thought here, but what about long-term care, right? So statistically, 1 out of 3 people will use long-term care before they die. 1 out of 3. And if you look within our nation, the average cost of long-term care is about $7,000 a month in the United States. So here's what I want to ask you. I want you to take your expenses as you perceive them to be in retirement, and then just go ahead and add a $7,000 bill on top of those expenses. And now tell me how long you think your money will last. So for most people, that's going to be a almost impossible scenario, right? That's going to destroy their retirement. So again, I'm not only thinking about the accumulation phases of rising up that mountain, of climbing Mount Everest, I'm also thinking about the exit. And that's one big differentiator between, I believe, what my methodology is and that of a lot of other people, is that I'm taking the macro perspective and that I want to take account for everything. Not only the good, because good things can happen and you ought to have good things happen, but moreover the bad things. And so I tell people all the time, if you adhere to my planning philosophies of balance and diversification and risk mitigation, I can almost guarantee that you may not enjoy the highest of all highs. What I can say though is that you will be shielded from the lowest of all lows. And in my experience, most people appreciate that. So you've heard me say it a couple of times. It's not about how much money you make, it's about how much money you keep. So this is a really cool piece here. This goes to showing again the power of the market in good and in bad times. And it's going to show us the effects of experiencing early losses versus experiencing early gains. And if you look here to the left, you have the Hatfields and the McCoys. And you see that they have this $500,000 balance in their 401k, and they're going to take a 5% distribution, and they're going to increase that distribution 3% every year to hedge inflation. So you can see that they've got a $25,000 distribution year one, and you'll see that center column grow up by 3% each year. And to the left, you'll see this hypothetical net return. Now, the interesting thing here is I'm going to take 2 identical market scenarios over the course of 30 years, and I'm simply going to flip them. So on the left, you're going to see the impact of taking early losses on an investment portfolio. And on the right, you're going to see the impact of early gains in a portfolio. So again, this is the scenario I just outlined in the previous Mount Everest slide. Let's say you have $500,000 and the market drops 35% in the first year you retire in the midst of taking your distributions. So you even now see that your balance you took decades to accumulate. I'm sure it goes down from $500,000 to $296,000 in the first year. Next year, you have a positive return, 2%, then 11%, 5%, and so forth. But look at the impact from the negative years, in particular circled in red. How scary is it that at this point, at age 80, in the Hatfield scenario, on the left, the money's all gone, all of it. They have nothing left, and they're only at age 80. So their life expectancy is 87. Statistically, by the way, between a married couple, a husband and wife, there's a 50% chance that one of the two will live beyond the age of 90. So if all of your money is gone at age 80, what are you going to do? Tough question, right? So let's take a look here at the right. We have the McCoys. The McCoys, they experienced early gains. Let's look at the impact of early gains. They started with that same $500,000 balance, same 5% distribution, increasing every year at 3% to hedge inflation. But look here, in this scenario, you have some early gains. You have a 9% gain, a 28% gain, and you have a loss in year 3. But look at the first 10 to 12 years, so that they were almost all positive, right? So then if we look at that impact at age 80, you have $1.4 million in this scenario versus having zero. And if you go all the way down to age 95, in the midst of taking a huge 35% loss at that year, there's still $2.1 million in that portfolio. So here's my question to you. Which of these two scenarios are you going to experience in retirement? Which one's going to be you, the Hatfields or the McCoys? And if we're honest with ourselves, right, the only truthful answer is we don't know, right? We don't know if the market's going to go up or if it's going to go down and when it'll do that, right? So to the extent that you would like to remove equity risk, real estate risk, and business risk from the equation, allow me to put a stop loss in. Allow me to guarantee a semblance of your retirement income so that you're in this scenario. How does that sound to you? So this is just a synopsis here. You receive $453,000 over 15 years, and you're out of money at age 80, or if the market did really well when you first entered, you receive $1.2 million over the course of 30 years and have $2.1 million left over. Who knows? Now, does this mean that equities are good or bad? No, I believe in a well-balanced portfolio. I think it should have equities in it, but to the extent that you want a certain semblance of your money that's not subject to the risk, and to the extent that you want a certain semblance of your income guaranteed, let's go ahead and establish that today. So if we experience the Hatfield scenario, your entire outlook isn't derailed, and to the extent that we experience the McCoy scenario, great, you'll have that much more money to spend in retirement and to leave to your loved ones. That brings us to the conclusion here, and my call for your action is to go ahead and book an appointment. If you're feeling like, oh my goodness, what do I do? Go ahead and book a strategy session, because here's the thing, I can't say it enough. There is no perfect product, guys. This whole presentation speaks to balance. It speaks to diversification. If someone has a 401k, it's doing well and they're matching, look, I don't want to mess with that, right? Allow me to shore up the areas that you don't have set up. Or if you have a 401k and you already have permanent life insurance, let me put that long-term care in place. Or if you have long-term care and you have permanent insurance, but you don't have any equity exposure, let me show you how to put that in place as well. So between life insurance, long-term care insurance, disability, after-tax investments, pre-tax investments, estate planning, after-tax planning, hardly anyone has it all, right? So I like to say, look, if there's 10 things you need to be financially secure and you've effectively done seven of them, I don't want to undo any of the good work that you've already done. In fact, I'll actually affirm the 7 good things that you've done. I merely want to identify those 3 areas of vulnerability, and more importantly, I want to show you how to protect yourself and solve those problems. How does that sound to you? So I hope you found value in this presentation, and I hope I've sufficiently disturbed you enough to take action and book a strategy session. You can get on my schedule. You'll see on my website, www.lifemoreabundantly.com. That can link you in, and you can set up a time to explore options further. Again, I want to thank you for your time. I'm honored to be part of your day today, and hope the rest of it is a great one. Look forward to speaking with you soon.